What if the biggest move in the silver market has nothing to do with silver itself? What if one political decision and one warning from a legendary billionaire investor have just changed the outlook for precious metals in ways almost nobody is talking about? President Donald Trump has signed a major order that is sending shockwaves through global markets. At the same time, billionaire investor Howard Marks has issued a warning that every investor should hear. Could this be the moment that changes the future of silver forever? Stay with me, because what is happening right now could impact every silver owner around the world. Welcome back to Silver and Gold Watch, where we break down the biggest stories shaping the future of precious metals and the global economy. Today, we are connecting two major developments that many people are looking at separately. On one side, we have a major policy move from President Trump. On the other side, we have a powerful warning from Howard Marks, who has spent decades navigating some of the most challenging financial environments in history. When these two stories come together, they paint a picture that every investor should understand. Markets often react long before headlines explain why. Professional investors know that the biggest opportunities appear when the majority of people are focused on the wrong story. While many traders are watching daily price swings, the smart money is studying policy changes, debt levels, inflation, expectations, and the long-term direction of the economy. Trump has repeatedly emphasized strengthening American manufacturing, protecting domestic industries, and reducing dependence on foreign supply chains. Every major executive action that supports those goals has ripple effects throughout financial markets. Whether it involves tariffs, strategic minerals, infrastructure, or industrial investment, these policies influence demand for commodities, including silver. Silver is unique because it is both an industrial metal and a monetary asset. During periods of economic growth, industrial demand can push prices higher. During periods of financial uncertainty, investment demand can also support prices. This dual role makes silver one of the most fascinating assets in the world. Now consider the broader economic backdrop. Inflation remains one of the biggest concerns for households, businesses, and investors. Even though inflation has cooled from previous highs, many prices remain elevated. Consumers continue feeling pressure from housing, food insurance, healthcare, and energy costs. Central banks may celebrate lower inflation numbers, but many families still experience higher living expenses every single month. The Federal Reserve remains trapped between competing priorities. If interest rates stay high for too long, economic growth could weaken further. If rates fall too quickly, inflation could return with greater force. Every Fed meeting now becomes a major event because markets desperately want clarity about future monetary policy. Whenever uncertainty increases, investors begin searching for assets that can preserve purchasing power. Historically, gold has attracted the largest share of safe haven demand. Silver, however, often follows with even greater percentage gains once investment demand accelerates. That is why so many analysts are paying close attention to silver today. Physical inventories remain relatively tight compared to long-term industrial demand. Mining companies continue facing rising production costs, environmental regulations, and declining ore grades. New discoveries are becoming more difficult while demand continues expanding across multiple industries. Electric vehicles require significant amounts of silver. Solar panels consume large quantities of silver. Artificial intelligence infrastructure, data centers, advanced electronics, medical technology, aerospace systems, and military equipment all depend on silver in different ways. The modern economy simply cannot function without it. Now add geopolitical uncertainty to the equation. Global trade relationships remain under pressure. Supply chains continue adjusting after years of disruptions. Governments are increasing investments in domestic production of strategic materials. Silver sits at the center of many of these initiatives because of its unmatched electrical conductivity and industrial versatility. This is where Trump's latest order becomes particularly important. Any policy designed to strengthen domestic manufacturing or secure critical resources increases attention on strategic metals. Investors immediately begin asking whether future demand could exceed available supply. Howard Marks approaches markets differently from short-term traders. Throughout his career, he has emphasized understanding cycles rather than predicting exact market timing. His letters consistently remind investors that risk often builds quietly during periods of optimism, while opportunities emerge during periods of fear. One of his most important lessons is that investors should focus less on headlines and more on long-term fundamentals. Short-term volatility may create emotional reactions, but lasting wealth is often built by recognizing structural trends before they become obvious. Today, many structural trends appear favorable for precious metals. Government debt continues climbing. Budget deficits remain historically large. Central banks around the world continue accumulating gold at remarkable levels. Geopolitical tensions remain elevated. Industrial demand for silver continues expanding. None of these trends appear temporary. Government debt deserves special attention because debt eventually influences monetary policy. As borrowing costs rise, governments face increasing pressure managing interest payments. Some analysts believe this environment may eventually encourage lower interest rates or additional liquidity measures if economic growth weakens significantly. Historically, periods of expanding liquidity have often supported higher prices for hard assets, including gold and silver. Investors begin looking beyond paper assets toward tangible stores of value that cannot simply be created through monetary expansion. Meanwhile, the US dollar remains another critical variable. A stronger dollar often creates short-term pressure for precious metals because commodities become more expensive for international buyers. A weaker dollar frequently supports higher metal prices by improving global purchasing power. Currency markets respond quickly to expectations surrounding interest rates, economic growth, and fiscal policy. Every new policy announcement therefore carries implications that extend far beyond stock markets alone. Another factor worth watching is central bank behavior. While central banks primarily purchase gold rather than silver, their continued accumulation sends an important message. Institutions managing national reserves appear increasingly interested in diversifying away from traditional reserve assets. That trend reflects growing awareness of geopolitical uncertainty and long-term currency risks. Silver investors naturally ask whether investment demand could eventually follow the same direction. Although central banks do not accumulate silver in meaningful quantities, institutional investors, family offices, and individual investors certainly can. Howard Marks frequently reminds investors that successful investing requires patience. Chasing momentum after prices have already surged rarely produces the best long-term results. Instead, disciplined investors prepare before broad public enthusiasm arrives. Right now, silver remains far below its inflation-adjusted historical highs. That fact alone attracts attention from analysts who believe long-term valuation still favors additional upside if supportive macroeconomic conditions continue developing. Technical analysts also monitor important price levels because market psychology often changes once major resistance areas break. Strong moves above previous highs can attract additional buying from trend-following investors while encouraging short sellers to exit losing positions. Yet markets never move in straight lines. Corrections remain completely normal. Volatility is part of investing, especially in silver, which has historically experienced larger percentage swings than gold. That volatility sometimes discourages new investors, but experienced participants understand that dramatic price movements create both risks and opportunities. Emotional decisions often produce poor outcomes, while disciplined strategies tend to outperform over longer periods. As Trump's latest policy begins influencing market expectations, investors are asking an increasingly important question. Are we witnessing another temporary headline or the beginning of a much larger shift that could redefine the future of silver? The answer depends on much more than a single executive order. It depends on inflation, monetary policy, industrial demand, fiscal deficits, geopolitical developments, investor psychology, and the global search for financial stability. And according to Howard Marks, ignoring these larger forces has often been one of the biggest mistakes investors make during major economic transitions. The next part becomes even more important because we will examine exactly how professional investors interpret these signals and why many believe silver could be entering one of its most significant periods in years. Professional investors are not asking whether silver will move tomorrow. They are asking whether the foundation for a major multi-year trend is quietly being built today. That difference in thinking separates long-term wealth builders from short-term speculators. Howard Marks has often explained that successful investing depends on understanding where we are in the economic cycle. Every cycle eventually reaches an extreme. Periods of fear eventually give way to optimism. Periods of optimism eventually create excessive risk. Investors who recognize those turning points often achieve the strongest long-term results. Today, many market participants remain heavily focused on technology stocks and artificial intelligence companies. Those sectors have produced impressive returns, but history shows that concentration risk becomes dangerous whenever too much capital flows into a single group of assets. Diversification becomes increasingly valuable during uncertain periods. That is one reason why institutional investors continue reviewing allocations toward commodities, precious metals, and other real assets. Silver stands out because it offers exposure to both industrial growth and financial uncertainty at the same time. Very few assets possess that combination. Suppose global economic growth remains stronger than expected. Manufacturing activity could accelerate, renewable energy projects could expand, electric vehicle production could continue increasing, data centers supporting artificial intelligence could require additional infrastructure. All of those developments increase industrial demand for silver. Now consider the opposite scenario. Suppose economic growth slows sharply, markets become more volatile, investors begin seeking defensive assets. Central banks respond with lower interest rates or renewed liquidity measures. Under that environment, investment demand for silver may increase alongside gold. In both cases, silver maintains a potential source of support. This does not guarantee higher prices. Markets always involve uncertainty. But understanding multiple demand drivers helps explain why many analysts remain optimistic about the long-term outlook. Mining supply presents another important piece of the puzzle. Developing a new silver mine requires years of exploration, permitting financing, construction, and production. Supply cannot suddenly increase because prices move higher for a few months. Many silver mines also operate as byproducts of copper, lead, zinc, and gold production. That means silver supply sometimes depends more on other metals than on silver prices themselves. If base metal production slows because of weaker economic conditions, silver output may also decline even while investment demand increases. That creates an interesting imbalance. Demand can change relatively quickly. Supply often changes very slowly. Markets frequently experience significant price movements whenever those two forces move in opposite directions. Another trend attracting attention involves physical silver ownership. During periods of financial uncertainty, investors often purchase coins, bars, and bullion products instead of paper investments alone. Physical demand removes available inventory from the market. When enough investors choose physical ownership available, supplies can tighten faster than expected. Premiums above spot prices sometimes increase under those conditions, reflecting stronger retail demand. Institutional investors monitor these developments carefully because physical market conditions occasionally provide early signals before futures prices fully respond. Meanwhile, exchange-traded funds remain another important source of demand. When investor confidence toward precious metals improves, large inflows into silver-backed funds can create meaningful buying pressure. Conversely, periods of pessimism often generate outflows. Watching these flows helps analysts understand changing investor sentiment. Now let us return to Trump's latest policy decision. Every government action affecting trade, manufacturing, infrastructure, taxation, or strategic resources influences business expectations. Companies respond by adjusting investment plans. Manufacturers reconsider supply chains. Commodity traders reassess future demand. Financial markets begin pricing possible long-term effects. Sometimes these reactions happen gradually. Sometimes they happen almost immediately. Markets constantly evaluate not only current conditions, but future expectations. That explains why headlines alone rarely tell the full story. Professional investors spend more time asking what happens next than reacting to what already happened. Howard Marks has repeatedly warned against emotional investing. Fear encourages investors to sell near market bottoms. Excitement encourages investors to buy near market tops. Neither approach produces consistent long-term success. Instead, disciplined investors build positions carefully while remaining flexible as new information appears. That philosophy becomes especially important in silver because volatility often tests investor patience. Silver has experienced dramatic rallies throughout history. It has also experienced painful corrections. Those who survive both phases usually focus on long-term fundamentals rather than daily price changes. Another issue worth discussing is inflation expectations. Markets care less about current inflation than future inflation. If investors believe inflation may remain elevated for years, demand for real assets often improves. Gold usually benefits first. Silver frequently follows with greater percentage moves once momentum develops. Real interest rates also deserve attention. When inflation exceeds interest rates, holding cash becomes less attractive. Investors begin searching for assets capable of preserving purchasing power. That search often includes precious metals. Global debt continues reinforcing this discussion. Government borrowing remains enormous across many developed economies. Servicing that debt becomes increasingly difficult if interest rates remain elevated indefinitely. Many economists believe policymakers will eventually face pressure supporting growth through easier financial conditions. Such environments have historically been constructive for precious metals. Geopolitical uncertainty creates another layer of complexity. Trade disputes, regional conflicts, sanctions, shipping disruptions, and political instability all increase investor demand for diversification. Precious metals have served as financial insurance during uncertain periods for centuries. That historical role remains relevant today. One overlooked factor involves investor psychology. Bull markets often begin quietly. Only a small group recognizes changing conditions early. As prices gradually rise, more investors notice. Media coverage increases. Public participation expands. Eventually, enthusiasm reaches extremes. Howard Marks consistently reminds investors that the best opportunities usually appear before widespread excitement begins. Many silver supporters believe current conditions resemble that earlier phase rather than the final stage. Again, there are no guarantees. Every investment carries risk. Unexpected economic strength could support higher interest rates longer than expected. A stronger dollar could temporarily pressure commodity prices. Industrial demand could fluctuate with global manufacturing activity. These possibilities deserve careful consideration. Successful investors evaluate both bullish and bearish outcomes. They prepare for volatility rather than assuming markets will move exactly as expected. That balanced approach often produces better decisions than emotional optimism or excessive pessimism. The coming months may prove especially important because markets continue evaluating monetary policy, fiscal developments, geopolitical events, and industrial demand simultaneously. Each new economic report may shift expectations. Each central bank meeting may influence currency markets. Each policy announcement may reshape investor confidence. Silver sits directly at the intersection of all these powerful forces. That explains why so many experienced investors continue paying such close attention even during periods when prices appear relatively quiet. Because sometimes the biggest moves begin long before the majority realizes that the trend has already started. So where does all of this leave silver investors today? The answer is surprisingly simple. The market is entering a period where long-term fundamentals appear far more important than short-term headlines. Daily price swings may continue. Unexpected news may create temporary volatility. Strong rallies may be followed by sharp pullbacks. That has always been part of the silver market. But beneath that volatility, several powerful trends continue moving in the same direction. Industrial demand continues expanding. Global debt continues rising. Central banks continue showing confidence in precious metals through record gold purchases. Governments continue investing in strategic industries. Geopolitical uncertainty remains elevated. Supply growth remains limited. Each one of those trends matters by itself. Together, they create an environment that deserves serious attention. Now think about the message Howard Marks has shared throughout his career. Markets reward patience. They reward discipline. They reward investors who prepare before everyone else recognizes the opportunity. That does not mean buying blindly. It means understanding risk. It means avoiding emotional decisions. It means building positions based on research instead of fear or excitement. One mistake many investors make is expecting every bullish story to produce immediate price gains. Real markets rarely work that way. Prices often spend months moving sideways before breaking into entirely new ranges. Those quiet periods frequently test investor confidence. Some people become frustrated and sell. Others remain focused on the larger picture. History has shown that major bull markets often begin when public interest remains low. That is why experienced investors pay attention to positioning rather than popularity. When everyone already believes prices will rise, much of the buying has already happened. When uncertainty dominates conversations, opportunities sometimes become more attractive. Silver has experienced that pattern many times before. Periods of disappointment have often been followed by surprisingly powerful recoveries. No one knows the exact timing. No one can predict the precise day or week that momentum will accelerate. But investors can monitor the factors that usually appear before significant moves. Watch inflation expectations. Watch Federal Reserve policy. Watch Treasury yields. Watch the strength of the US dollar. Watch industrial production. Watch manufacturing activity. Watch physical silver demand. Watch investment flows into precious metal funds. Watch government policy surrounding strategic industries. Most importantly, watch whether confidence in paper assets begins weakening. Because confidence drives financial markets. When confidence is strong, investors often prefer stocks, bonds, and cash. When confidence weakens, capital frequently begins flowing toward hard assets. Gold usually leads. Silver often follows with remarkable speed. Another important lesson involves portfolio balance. Many successful investors never place all their money into one asset. Instead, they spread risk across multiple investments. Silver may become one part of a diversified strategy rather than the entire strategy. That approach reduces emotional pressure during periods of volatility. Howard Marks has repeatedly emphasized controlling risk instead of chasing maximum returns. That philosophy remains valuable today. Investors should ask themselves several important questions. What happens if inflation remains stubbornly high? What happens if the Federal Reserve cuts rates faster than expected? What happens if global manufacturing accelerates? What happens if geopolitical tensions increase? What happens if government deficits continue expanding? Each answer points toward one conclusion. Silver deserves careful attention. Now let us return to Trump's latest order. Regardless of political opinions, markets respond to policy. Businesses react. Investors react. Global competitors react. Supply chains adjust. Capital flows change direction. Commodity markets eventually reflect those changes, sometimes quickly, sometimes slowly. The important point is that policy decisions influence expectations, and expectations often move markets long before official economic data confirms what is happening. That may be exactly what we are seeing today. Professional investors are looking beyond tomorrow. They are asking what the world may look like 3 years from now, 5 years from now, even 10 years from now. Will governments continue borrowing at historic levels? Will central banks eventually ease monetary policy again? Will industrial demand for silver continue expanding through artificial intelligence, renewable energy, defense technology, and advanced manufacturing? Will investors continue searching for assets that preserve purchasing power? These are the questions shaping long-term investment decisions. They matter far more than one trading session. They matter far more than one headline. Silver has always been a market driven by patience. Those who understand its cycles often recognize that the strongest opportunities rarely appear obvious at the beginning. Instead, they develop gradually while most people remain distracted by short-term noise. That is why today's environment deserves close attention. The combination of economic uncertainty, industrial transformation, government policy, and investor psychology creates conditions that could define the next chapter for precious metals. Will silver move straight upward from here? Probably not. Markets never move in perfect lines. There will almost certainly be corrections. There will be disappointing weeks. There will be unexpected headlines. But if the long-term drivers continue strengthening, each temporary setback may simply become another chapter in a much larger story. And that may be the biggest lesson from both Trump's latest move and Howard Marks's warning. Successful investors do not react to every headline. They study the trend beneath the headlines. They prepare before consensus changes. They remain patient while others become emotional. And they understand that wealth is often built during periods when the majority is still looking in the wrong direction. The next few months could become some of the most important for silver in years. Every inflation report, every Federal Reserve decision, every major policy announcement, every shift in the US dollar, every sign of stronger industrial demand, and every change in investor sentiment may provide another clue about where this market is heading next. The silver story is far from over. In many ways, it may only be beginning. If you found this analysis valuable, make sure you subscribe to Silver and Gold Watch so you never miss the biggest updates affecting gold, silver, and the global economy. Leave a comment below and tell us one simple question. Do you believe silver reaches a new all-time high during the next major bull market? Thank you for watching, and I will see you in the next video.